Welcome, everyone, to the series Facing Inequality. I'm James Foster here in Washington, D.C., where I direct the Institute for International Economic Policy, or IIEP as we call it, at the George Washington University. I'm also the moderator of today's conversation on inequality with political economist Benjamin Braun of the Max Planck Institute, entitled Central Banking in the Age of Inequality. For those of you who've attended an IIP event, either on site at the Elliott School or virtually, you can expect an informative, nonpartisan exchange of views on topics like digital trade, global governance, US-China economic relations, or global poverty. Last week, representatives from the IMF's Africa division presented a sobering view of the regional economic outlook on sub-Saharan Africa, focusing on COVID-19, climate change, and digitalization. Tomorrow's event in IEP will feature Sabina Alkire and colleagues from the Oxford Poverty and Human Development Initiative at Oxford University and from the UN's Human Development Report Office, presenting the newest results from the Global Multidimensional Poverty Index. This is UNDP's global poverty measure based on methodology that I developed with Sabina Alkire. Our discussants for the event will be former UN Assistant Secretary General Ajay Chibber, who is also a distinguished scholar in our institute, Frances Stewart of Oxford, who helped guide the early human development reports, and our neighbor Dean Jolliffe from across the street at the World Bank, who is the resident expert on poverty evaluation there. It should be a very informative discussion of the state of global poverty under COVID-19. Today's Facing Inequality event is the sixth in our series, which began with Branko Milanovic several weeks ago and has continued about every 2 weeks since then, with contributions from speakers and discussants across multiple disciplines. Next week's event will feature Professor Nita Rudra from Georgetown's Government Department, who will discuss informality and international trade. You can find videos of our events on IEP's YouTube channel or by going to our website at iiep.gwu.edu. Please have a look. Now for today's event. I thought it would be appropriate to note that today and tomorrow, a few blocks away from GW, the 12-person Federal Open Market Committee will be meeting to set monetary policy for the US. Will their choices result in greater inequality in income and wealth? In a paper entitled Monetary Policy and Inequality, former Fed Chair Ben Bernanke concluded that monetary policy is a blunt tool, which certainly affects the distribution of income and wealth, although whether the net effect is to increase or reduce inequality is not clear. He called for more research to untangle and measure the many channels through which these effects are transmitted. But as our speaker today points out, central banks, both here and in Europe, are going far beyond the traditional mix of open market activities. Perhaps the impacts of these new facilities on inequality are more easily understood. Today we have two great discussants, Aditi Sahasra Buddha, who will be joining Georgetown this fall as a pre-doctoral fellow and as a doctoral student in government at Cornell. My own PhD is from Cornell as well, so good to see you. Specializing in the politics of international finance and central banking. Have a look at her new article in the Review of International Political Economy on how swaps saved the world in 2008. Our second discussant is Trevor Jackson of GW's History Department and IEP, who works on inequality and crises and has also been writing for the popular press in outlets like Dissent and Foreign Policy. Moreover, he's a co-founder of the Facing Inequality series and will now introduce our speaker and explain the rationale behind the series as a whole. Trevor?
Thank you, James, and thank you for that kind introduction. So this Facing Inequality series emerged out of the before times when we would meet in person and discuss inequality from a variety of disciplinary standpoints. This came from an interdisciplinary university seminar at GW, founded by myself and Brian Stewart from GW's economics department. And we realized that since about, either Occupy of 2011 or the blockbuster success of Thomas Piketty's Capital in the 21st Century in 2014, that inequality had become one of the salient issues of our time, both intellectually and in terms of policy and political challenges. And what we learned is that although many different people from many different disciplines and backgrounds are interested in inequality, we often aren't clear what each other are talking about. And so we founded this series as a way of bringing together historians, economists, political economists, lawyers, philosophers, policymakers, academics, and activists to speak across our lines about how we approach inequality. And so we transitioned online in March, and our first speaker in this Facing Inequality series was Branko Milanovic. You can still find that talk on IEP's website, as the others that have followed. And we will continue as long as inequality does, which is to say for the foreseeable future. Our speaker today is Benjamin Braun. We're very pleased to have with us. He is a political economist at the Max Planck Institute for the Study of Societies in Germany and a member of the Institute for Advanced Study at Princeton. If you read at all in the literature of the state finance nexus, especially creative and innovative new thinking about monetary policy and unconventional monetary policy, Ben's work is suddenly everywhere. He is in the popular press. He is appearing in journals like the Review of International Political Economy, the Socioeconomic Review, New Political Economy, and has really been at the forefront, I think, of thinking about what central banking and monetary policy has meant since the great crisis of 2008, and how the most recent crisis, which seems to have exacerbated and extenuated all of the existing patterns of inequality, have also affected our thinking about monetary policy and central banking. So he is going to speak to us today about central banking in the age of inequality before we return to the discussants, and you will see me once again at the end. So Ben, thanks for joining us, and take it away.
All right. I hope you can all hear me.
Yep.
Excellent. Let me start. Thank you, James and Trevor, for the invitation to speak and for this kind introduction. I'm just timing myself here. Okay, so the title of my talk is Central Banking in the Age of Inequality, which is a grand title. And of course, what I will present is just one cut into this big topic. I will draw on my own ongoing work. There are different pieces of it, and several of them actually link to this topic. That's why I'm grateful for the opportunity to speak in this series. But like I said, it will be impressionistic and incomplete, and so I look forward to the discussion with Aditi and Trevor, and then hopefully also a Q&A. All right, so this is the agenda for my talk. What do central banks do is the first question that we need to ask, and then I'll briefly introduce the idea that there are three pathways that we can fruitfully investigate as social scientists when it comes to this question. And I'll go through them with various examples and then conclude. So what is it that central banks do? Someone is not muted. I'm just mentioning it. It's quite loud. So the list is long and much longer than many people or casual observers of monetary policy would suspect, maybe. That's why I put it here at the beginning of my talk, because the answer to the question, do central banks increase or decrease or not affect at all income and wealth inequality, would be much easier only if conventional monetary policy was the only thing central banks did. So set the short-term interest rate with the goal of managing the inflation rate, which has been for several decades now sort of the public image displayed by central banks, and of course also the core of the so-called inflation targeting paradigm that really dominated monetary policy pretty much everywhere in the world prior to the 2008 financial crisis. But this type of monetary policy, this is only one thing that central banks do. Since the financial crisis especially, they also supervise financial institutions. They do supervision, microprudential supervision in some countries, macroprudential supervision, looking at systemic risks to a much greater extent than before the financial crisis. Of course, the 2008 financial crisis, and again this year, as a result of the COVID-19 pandemic, we have seen what had almost been forgotten prior to 2008, that central banks historically are really responsible for backstopping the financial system. And there are several dimensions to this, not just a Baytaught rule, lender of last resort to the banking system. We'll get to that. Central banks have also conducted asset purchase programs on a very large scale. They have recently restarted if they had ever stopped doing so after 2008. This is partly a financial stability measure, but also it morphed into a macroeconomic measure with very significant effects on wealth, in particular, household balance sheets, and therefore net wealth of different types of economic actors. And then, very importantly, and something that economists in particular haven't looked at so closely, but that political scientists and sociologists have studied in recent years, central banks also shape financial markets by being the biggest player in financial markets. And of course, they have become much bigger players over the last 12 years. And then central banks also influence government policy in various ways. Financial market policy, but also, and I will speak about that briefly too, labor market policy. So these are things that are not in the textbook, but that are very important when it comes to the question about the relationship between central banking and inequality. This list is not exhaustive. There are more things that central banks do, such as international monetary diplomacy and so on. We can't even list them all. All right. So what then about the relationship between central banks and inequality? I think that for the purposes of this talk, we can think of this as consisting of three causal pathways. One is central banks directly, through their actions, change the distribution of income and or wealth. And I've listed a couple of examples for each of these points. I won't go through them now. We'll do them in the rest of my talk. Then central banks change government policy. They do so partly simply instituting an independent central bank, where central bank independence already changes the behavior of the government. But then central banks are also active participants in policy making to an extent that may be quite surprising if one hasn't looked closely. And that's another important point, especially from a political science perspective. There's also the reverse, of course, that central banking in a world that is, characterized by high equality, low inequality, is very different from central banking in a world of high income and or wealth inequality. So central banking is affected when inequality is high, as is currently the case in many places in the world. All right, so let's look at the first point. Central banks change the distribution of income or wealth themselves. And I will only touch upon two of the many things that central banks do in the context of this discussion. The first is conventional monetary policy, which is still important, and especially I want to spend some time talking about conventional monetary policy, because historically, when central bankers have addressed the question of inequality or the distributional consequences of monetary policy, they talk about conventional monetary policy. Here is a quote from Benoit Cœuré of the European Central Bank, formerly the European Central Bank, who said that central banks should refrain from engaging in income distribution, which should be sanctioned by parliaments. This does not imply that monetary policy actions do not have distributive consequences. In fact, they always have. So he is acknowledging that, as most central bankers do. But these distributional consequences are the side effects of a strategy that aims to ensure price stability, which is by essence neutral as regards income distribution. So price stability is a good thing and is neutral with regard to income distribution, which is why monetary policy is predominantly neutral with regard to its distributive consequences. This is the paradigm that underpinned the institution of central bank independence and the policy paradigm of inflation targeting. It is much easier to justify the exception from democratic accountability that central banks enjoy if one can make the argument that they do not have a major impact on distribution. And that, I will argue, is a very doubtful proposition. Here from a recent and very highly cited paper on the redistribution channel of monetary policy are three. This is, I would say, I'm not an economist myself, but I read the economic literature on these things and follow it quite closely. This is the state of the art, and this is published in the American Economic Review. So I think it is a significant publication and acknowledgement of in the core of mainstream economics that monetary policy may have more to do with distribution than has hitherto been assumed. And so Auclair mentions these three channels: the earnings heterogeneity channel, through which monetary policy affects income inequality. So there is a labor share and there's a capital share, and different households and different households depend to a larger or smaller extent on income from labor versus income from capital. So that is one dimension on which household heterogeneity means that monetary policy affects different households in different ways. There's the so-called what Auclair calls the Fisher channel. So there are nominal creditors in an economy and nominal debtors. High and unexpected inflation is, other things equal, better for nominal debtors because it erodes the value of the debt the debtor has to repay. And then there is the interest rate exposure channel, and Auclair makes the important point that one can't just look at asset holdings of a household to determine how they are affected by monetary policy. The simple argument is, for example, quantitative easing benefits rich people because they hold financial assets, and QE inflates the value of financial assets, and there is certainly something to that. But for deep analysis of this problem, one needs to look at asset duration and liability duration. And so there is an interest rate exposure question on both sides of a household's balance sheet. Anyway, this is just to set the scene. There is a debate on this, but it is quite recent, and this is, I think, the paper that has done the most to set the stage for this debate in economics in recent years. Now, what about conventional monetary policy? When we talk about conventional monetary policy, in a textbook or in the media, the figure of Paul Volcker looms very large. He's no longer with us, but the memory is important of what happened when he took office as Federal Reserve Chairman in August 1979. Here is the US unemployment rate without the most recent spike, which would have changed the scale here. So I cut it off at the end of 2019. And what you see is so far up to recently the highest unemployment rate since 1950 in this series was in the early 1980s, which of course this spike in unemployment was a result of the so-called Volcker shock, which refers to the episode of the Federal Reserve under Volcker raising rates to basically generate a recession, drive up unemployment, and thereby get inflation under control. And the goal was, of course, to get inflation under control, but the intention of the interest rate hike was nevertheless to create a recession. There was no way around that, even though the Fed tried to hide its hand in this recession. And now here is a different picture. This was the unemployment rate. Now here we're looking at, so this, what happened after August 1979 to unemployment was bad for people who depended primarily on their income from labor, obviously. Here we are looking at the real return on wealth, R, as measured in the excellent paper by Jorda et al. And the difference between the real return on wealth and the real GDP growth, G. So this is Piketty's R greater than G with actual data for 16 countries from 1870 to 2015. This is from the paper, The Return on Everything. So this is for 16 countries, but of course this is weighted. And so the US financial returns loom large here. And what you can see is that the real return on wealth went up in the early 1980s and then stayed up during the period of inflation targeting, when inflation had been brought under control. And of course, Volcker did raise interest rates very high, and it took a long time for them to come down. This is not the safe asset interest rate. That's a different chart in this paper, but the real return on wealth. So this includes returns on housing wealth and equities and bonds. But what one can see is that since, whereas during the two world wars, of course, but then also during the 60s and 70s, the R minus G gap was relatively, historically, small. And it went up to sort of 1900 levels when after inflation was brought under control by central banks globally, but primarily by the Fed, and then other central banks followed during this period. So the period since then has been a very good one for owners of financial wealth, who participate, whose income depends more on the capital share in the economy than on the share going to labor, because they derive more income from capital than from labor. Now, what did Paul Volcker think about this? Here is a famous quote from the book by Greider, Secrets of the Temple, when Paul Volcker said to a group of legislators from farm states that, look, your constituents are unhappy farmers, mine are not. It's not entirely clear who he is referring to as his constituency, but one can assume that it's not his constituency in this quote, but people who benefit more from the real return on wealth, and of course financial institutions, and we'll get to those in a minute. Now, Central banks have other functions, not just conventional monetary policy in the fighting of inflation. They are backstopping the financial system, and they do so in various ways. They are, of course, the lender of last resort to the banking system. Here, what research has shown, I'm quoting here from a very interesting paper by Calomiris et al., where they show or argue that historically central banks have moved, or let's say financial market policy in general, including central banking, have moved towards a doctrine of ultimate, what they call ultimate protection. So according to Bagehot's rule, central banks should be stingy as lenders of last resort to the banking sector. So lend at market rates and not make it too easy for banks to borrow from the central bank in a crisis in order to not create moral hazard. Whereas what Calomiris et al. Show is that gradually over decades, and then culminating in the central bank response to 2008, and I think this holds up for what we have seen so far in 2020, central banks simply were pushed towards ever more, let's say, lenient lender of last resort behavior towards banks, simply because too many banks became too big to fail. The banking system became more concentrated, and for various other reasons that I don't want to go into, the lender of last resort has become more generous, which of course has distributive consequences if banks basically no longer go insolvent. Of course, there was Lehman, but Lehman was a big exception. Then central banks, in the phrase of Perry Merling, also became dealers of last resort to the broader financial system in various ways. The ECB through collateral easing and other programs, the Fed, of course, through the Treasury's TARP program, the asset relief program, but also other asset relief programs. Quantitative easing is another component of this, of course. So whereas only banks benefit directly from the lender of last resort role of central banks, a much broader set of financial actors benefits from the dealer of last resort role of central banks. Finally, central banks are also international lenders of last resort. This applies first and foremost, of course, to the Federal Reserve because of the dollar-dominated nature of the international monetary and financial system. So the US dollar swap lines, the Fed extended to foreign central banks in the last crisis and again in this crisis, also have distributive consequences because they are granted to some countries only and not to others. This is what Aditi's research has been about, and I think she will get back to this briefly in her comments. Historically, also, central banks outside of the United States have conducted US dollar denominated swaps with their own domestic banks, again, protecting them from losses when dealing, in this case, in the euro-dollar market. Now, where does it leave us? It's probably fair to say that central banks have developed into guarantors of the solvency of financial institutions and not just of banks, which, as I said, does have distributional consequences because that means shareholders of financial institutions take fewer losses. Shareholdings are distributed very unequally in the population. And it means that the bankers themselves take fewer losses because they keep their jobs and, in many cases, their bonuses. And central banks have become asset price underwriters. The dealer of last resort, all of these functions have the consequence that asset prices stay higher than they would otherwise. And of course, I'm not saying that central banks should not act as lender or dealers of last resort. This would be ludicrous given the consequences, but that does not mean that one shouldn't note that central banks have been extremely aggressive in the last two financial crises, and I'm counting the current situation as the second one after 2008, in underwriting asset prices. Asset prices right now, as many observers have commented, are surprisingly high given the situation the world economy seems to be in with the pandemic. And again, asset holdings, or financial asset holdings especially, are extremely unequally distributed. I won't go into that in this talk, but I think it's probably common knowledge among the audience. In the Q&A, I'm happy to talk more about other effects of dealer of last resort functions on other financial actors, such as hedge funds and private equity funds, and how they benefit from these interventions, which is, I think, a very important component of a critique of dealer of last resort central banking, and what could be done about it, which I think the answer would be conditionality / regulation of these actors that benefit from these operations, but I'll leave that to the Q&A. Now, the second causal pathway through which central banking has an effect on inequality is that central banks do, in fact, influence government policy, and through those policies, distribution. Here is a chart from a working paper by Acklin, Kern, and Negre. Does central bank independence increase inequality? They do a very nice job of disentangling this second causal pathway from the first. So there is macroeconomic policy in their terminology, fiscal policy and monetary policy. These policies are not available to governments when the central bank is independent. Fiscal policy is also, let's say, restrained when the central bank is independent. And so the government is more likely to try to stimulate growth and employment through microeconomic policy in labor markets, through financial regulation and social policy in ways that are likely to contribute to higher inequality. And Acklin and I'll show that through a quantitative study of many central banks in many countries, looking at the effect of central bank independence on these inequality enhancing or exacerbating government policies. I want to look at a different type of government policy channel here, which is when central banks actively advocate for specific policy changes. This is what some of my own work has been on, especially on financial market policy and labor market policy. So central banks themselves get involved in these issues. Here is the example of financial market policy in the euro area. My own work has looked particularly closely as the involvement of the European Central Bank in the regulation of the securitization market, so the market for asset-backed securities, the type of securities that was quite at the center of the subprime crisis in the United States, less so in Europe, except as assets held by European investors. And what one can see when studying this case, and I put the references, the two articles that talk most about this at the bottom of this slide, is that the ECB provided not only collateral easing and provided support to the securitization market not only through collateral easing and quantitative easing, but also through regulatory easing. And it wasn't the regulator, but it did advocate very early on, starting in 2010 and very consistently, for a path towards the standardization of securitization, simpler structures, and better post-trade price transparency. The opening quotes are missing here. So from towards, this is a quote by a member of the ECB's executive board at the time. And one can show that other executive board members all the way through 2015, 16 advocated very vocally for a strengthening of and revival of the European securitization market, even though it had a bad reputation still in 2010 in other parts of the political system, including at the European Commission. And this was because the European Central Bank was hoping that this would help banks to offload bad loans, and that it would help the European Central Bank to purchase more of these asset-backed securities as part of its quantitative easing program, like the Fed did with mortgage-backed securities. So it had an organizational interest in the revival of this market, and indeed it succeeded. The language used by González Páramo in 2010 became the language of EU legislation in 2017. So this is one case where the European Central Bank is very actively involved in financial policy making and financial market shaping. Now, a different and perhaps even less expected way the European Central Bank has been involved in government policy at the national level even is the labor market policy. So this is ongoing work. That a working paper of that will be available shortly. Here, the point is that monetary policy is one component of the macroeconomic policy mix. The others are fiscal policy, wage policy, regulatory policy. With EMU, with European Monetary and Economic Union, the European Central Bank and other macroeconomic policymakers, the national governments lost a lot of capacity for macroeconomic coordination by, using these four components of the macroeconomic policy mix in a coordinated fashion. Monetary policy was at the EMU, at the supranational level, these other policy areas at the national level. So in principle, there would have been two choices for social partners, trade unions, employer organizations, national governments, and the central bank. Two paths these groups could have followed in order to make the wage setting system, which is really a core component of the macroeconomic landscape, compatible with economic and monetary union. One would have been to build out a Euro-level collective bargaining infrastructure. So to upload whatever there was at the national level for a coordinated wage bargaining to the European level, which would have been extremely difficult, needless to say. Or option B would have been to destroy national collective bargaining infrastructures in order to create a much more flexible labor market to destroy non-market institutions such as trade unions, sector level bargaining, and so on, and to create a more, let's say, American-style liberalized labor market. The ECB chose option 2, and we show that in a paper that looks at ECB speeches and the speeches of some selected other national central banks, shown here on the right, the Bank of France, Spain, Bundesbank, and the Bank of Italy. But the red line is the ECB. That's what's of interest here. And we go into lots of detail in this paper, but what we can show is that the ECB, especially during the first period from 1999 to 2008, but then again after the euro area sovereign, or in the context of the euro area sovereign debt crisis, the ECB again became a very vocal advocate for structural labor market reforms in the euro area, and called on governments to deregulate and liberalize their labor markets in really countless speeches. And of course, weakening, as has become conventional wisdom recently, even in macroeconomics. There's a recent paper by Summers and Stansbury that makes a mainstream economics argument that is aligned with what industrial relations scholars have known for a long time. Weakening labor market institutions, wage setting institutions means weakening labor, and wages will tend to go down. So here again, there is a clear distributive consequence to this. And what is very stunning in our result is that the ECB has failed to achieve its price stability target for many, many years now. So inflation has mostly remained far below the 2% inflation target of the ECB. It has, in the last 3 years, completely stopped talking about, the ECB has completely stopped talking about structural labor market reforms in the last 3 years. This drop that you see in the red line is not a fluke. There is no mention of this topic anymore in ECB speeches in 2018 and 19. And when you trace what happened there, it is very clear that the ECB became concerned that it might be a problem in a deflationary macroeconomic context when labor simply does not have enough power to demand wage increases, even when economic growth resumes, as it had prior to 2020 in the euro area. And so they apparently decided to stop asking governments to do structural labor market reforms. Now, this is not just the ECB. Again, here's a couple of Volcker quotes about how he thought about the role of crushing the power of labor in order to rein in inflation in the 1990s. So this is just to give some context that this is not unique, that central bank interest in labor market policy is not unique to the euro area. I won't go into that in detail. There's no time, unfortunately. Finally, there is the effect in the other direction. The justification for central bank independence is on much firmer ground when there is low inequality. When there is high inequality, so when distribution is unequal, this has an effect on central banks. And so in the remaining 5 minutes, I want to present some ongoing research where we try to measure, document the politicization of central banking that occurs as a result of the combination of unconventional central bank policies on the one hand and clear distributive consequences of these policies on the other hand. So central bank independence exists because the idea is to depoliticize monetary policy, and what we try to document in this project is to the repoliticization of central banking. Here again, these distribution channels. This is a picture from a recent paper by Mian, Straub, and Sufi, which shows that the top 1% have been saving. There has been a savings glut for the top 1% in the US, whereas the bottom 90% have been dissaving. So this is just to illustrate the point that I won't go into all the other inequality data that one must cite to make this point, which here I put as a rule of thumb. The more economically unequal a society, the more illusory the prospect of a depoliticized central bank. The question is, how can we measure the effect this has on central banking? To do that, we hypothesize that central banks that conduct quantitative easing programs, and we have only 5 central banks in that data set of 19 central banks that had active quantitative easing programs since 2008, we hypothesize that these central banks talk less about contested topics related to quantitative easing than central banks that do not have active QE programs. And the intuition is there are problematic consequences in terms of house price inflation in particular. So that's a topic that we look at. Inequality more generally, and for central banks that target the exchange rate implicitly, notably the European Central Bank and the Bank of Japan. There is also an issue about the exchange rate. So just very briefly, we construct these dictionaries for these topics: the exchange rate, house prices, global warming, which is another relevant topic for QE programs that include corporate bonds, another delicate topic for central banks that are buying corporate bonds by issued by high emission companies, but not so relevant for the context of this talk, and inequality distribution. And what we find is that, so this is an event study design. We also have OLS regressions. I won't show these tables. But the effect is significant for house prices, exchange rates, and global warming, not for inequality in our regression. What you can see here is that after the introduction of quantitative easing, the dotted line in the middle, the two groups of central banks, QE central banks are the triangles, non-QE central banks are the circles. The dots diverge visibly in their public speeches about these topics. So there's a significant drop, statistically significant drop in central bank communication about house prices that increases over time. So central banks that do QE talk less and less relative to central banks that do not do QE during this period, even when controlling, of course, for house prices in these countries. There's also a significant effect for the exchange rate. For inequality, you can see this in the event study, even though the effect is not significant, but you can see the divergence here. And there is a significant effect for global warming, especially when looking only at the subsample of the two central banks that buy corporate bonds, the Bank of Japan and the European Central Banks. So the conclusion here is the way we interpret this is central banks display strategic silence on topics that are particularly delicate for them from a legitimacy perspective. And there is an important distributive consequence, distributive dimension here, because the effect is most pronounced for house prices, which obviously house price inflation creates a problem for people who do not own houses and makes those that own houses richer. To conclude, very briefly, I would say that there is pretty strong evidence that independent central banks have contributed to higher income and wealth inequality since the 1990s, even though, and I have not talked about this, believers would of course argue that by managing the economy well, central banks have contributed to income growth, even for the lower deciles of the income distribution. But at least that financial crisis casts doubt on that counter argument, I would say. And then with the myth of the distributional neutrality of central bank independence shattered, I see these three potential paths forward, and they're not mutually exclusive at all, to reduce the scope and reach of central bank power, central banking for a low inflation, high inequality world. So sort of the inverse of the 1970s, when inequality was much lower and inflation was much higher. And to make central banks more democratically accountable, even if that means to make them less independent. I'll leave it there. Thank you.
Thank you so much, Ben. Before I turn it over to the discussants, now would be a good time to formulate questions, which can be submitted via the WebEx Q&A function. Or if you'd rather be seen and heard, you can raise your hand. Now over to our first discussant, Aditi.
Thank you. And thanks, Ben, for such a great talk, as always. With all your research, I always learn a lot, and you give me a lot to think about moving forward. So that was really great. I'm going to focus my comments in three broad categories. The first one is just about your final argument, where you talk about central bank legitimacy and strategic silence. And the second one is mostly methodological and a few clarifying questions that I had in reading the papers associated with the talk. And the last one is about the broader implications of this research. And in this broader point, I'm going to sort of draw attention to three areas or layers of in which central bank practices have driven or can sustain inequality. And I'll add some of my own reflections on that issue. And in this point, I'm going to look at inequality in terms of wealth inequality and also intergenerational inequality. And then the third point would be on structural global inequality, to bring in some of my own research on swaps and the global financial safety net. So my first comment or question is, from whom are central banks seeking legitimacy? You've gathered some really great data from these speeches that you've looked into, and I'm so interested in hearing a little bit more about what the nature of these speeches are and who their audiences are. I've looked into quite a few of these BIS speeches myself, and I've noticed that central bank communication in general takes so many forms, be it at Jackson Hole, the congressional testimonies, also now more public-facing discussions that we see online. And for each of these, the audience is quite different, and the source in which perhaps this legitimacy seeking is taking place is also different, at least the way I think about it. So in thinking of this broader range of speeches and potential audiences, have you found there's a relationship between like where these speeches are being given and what topics get covered the most, or in more general terms, in what areas of social and economic and political life would you suggest central banks are most lacking in legitimacy and where they seem to be seeking it out? And in related to that, how can we square this increasingly legitimacy-seeking communication that you talk about with more internal conversations at central banks? As James reminded us that this is FOMC Day, and so to put this into that context of today's meeting and other meetings that they have, a lot of these topics, especially climate change and inequality, less so housing and exchange rates, don't necessarily feature as much in FOMC meetings, and it doesn't necessarily seem to be the bigger goal of what they are trying to do internally within these institutions. So do you think, again, that there's maybe a relationship between, or a negative one, I would imagine, between legitimacy seeking discourse and then the actual focus of what central banks are doing in their own internal deliberations? I've also found that central bankers in the last couple of years, especially, have become far more vocal on issues such as inequality and global warming. But this seems to be even more pronounced once they're out of office and in their communications from, say, think tanks and other institutes where they continue to conduct their own research, which seems like a sort of very calculated decision to not discuss very political salient issues while they are in office. So again, I mean, I know this is not something you discuss explicitly in the paper either, but I'd love to hear some of your thoughts on, what this focus of these topics is and why does it change once their terms have ended? Do you think it's sort of a longer term effort in central bank legitimacy seeking efforts, or do you think they just become more willing or able to publicly communicate on issues that are otherwise so politically salient that they don't do while they're in office? So to the second set of questions, and these are mostly clarifying, I will say, but in terms of the data and the methods you use for the very last part of your talk, I want to focus on the OLS regression and the event study that you've conducted. So I would really like to hear a lot more about which 19 central bank speeches you've looked into, and why you selected these specific ones amongst the larger possible universe of cases. And this is really probably more on me, but I was a bit confused in the tables as to the number of observations between the 1400 and 1200, when it looks like you've looked at almost 12,000 speeches. So again, is the observation just the counts of various the use of these words in the dictionary, or is there something else that maybe would just clarify how you've approached these models? But again, if I apologize if I missed something in the paper. And for the event study, I also wondered about the timing of like decisions on conducting QE in these five central banks, and is there much variation? What was the time zero for each of these events? And also, just to get a sense of your sense of why you think why there is no relationship between QE and talking about inequality in comparison to housing markets, exchange rates, and global warming. Of course, like I said, these are all clarification questions, but I think there's some really interesting dynamics underlying the models that you've captured, which I'd love to hear some more about. And my last set of comments is the dreaded "so what" question. And I think my conclusions and my takeaways might differ a bit from yours. I don't disagree with you. I just think that there's like so many ways in which this could be interpreted. So I'm convinced by your argument that central banks are increasingly engaging in legitimacy seeking discourse. But I wonder about the broader implications of this research. So central bank policies, as we know, and as you discussed today, are inherently geared towards preserving and protecting wealth that exists already. And this is obviously an important consequence of this is its in effect on driving inequality. And so given their focus on finance and pre-existing wealth and wealth accumulation, I would say it was inevitable that during the crisis, their policies were so focused on protecting this sector, on the financial sector and financial assets, and it seemed like a natural outcome that the concentration of wealth would be enhanced at this time. So, in that vein, I'm curious to hear your thoughts on what this means for the implication of central bank policy and politicization via strategic silence, on how we view their role in driving inequality. So I would imagine, insofar as central banks are able to gain the legitimacy that they seek through their communication, could it then mean, if this does work in their favor, that they're essentially off the hook in how their policies can impact or drive inequality? Or could it also mean that the impact on inequality will return to be overlooked in the public discourse if they are able to sort of increasingly legitimize how they operate and how they can affect these dynamics. So in other words, is central bank legitimacy seeking behavior also an avenue through which wealth inequality can actually be legitimized and sustained in the longer term? And also thinking about that inequality generating effect of central bank policies is that I think this is multiplied not just in terms of existing wealth inequality, but across generations and also structurally in the global economy. As we know, the crisis hit not just importantly, but not only poorer people, but also young people who collectively together don't they face increased barriers to acquiring assets because of a poorly performing labor market and the economy, plus in addition to austerity measures and increasing costs of education and gaining skills, which I think will further exacerbate the issue of pre-existing wealth inequality. And in my own conversations with central bankers, many of them have discussed this as a critical problem that arose from crisis management policies about a decade ago, that by targeting and protecting wealth accruing assets, they overlook the consequence that for many accumulating wealth is going to be even more difficult today than it's ever been. So in that context, I wonder if you came across anything on this particular issue and this source of increasing inequality in the bank speeches you've looked at or in any other research that you've done. And also in the context of unconventional policies, I have to touch on the international aspect of central banking, and we cannot ignore the inherent inequality in terms of access to liquidity, immunity from externally imposed austerity measures, and conditionality attached to IMF or World Bank loans, and of course the financial effects of QE and tapering in the US on emerging markets. And I want to focus on this not just in terms of accessing finance and the financial safety net, but that these countries already tend to have higher levels of inequality going in, and they're also most vulnerable to the effects of climate change, and that the driving effect of inequality by policies such as QE or advanced economy monetary policy is multiplied in emerging and developing economies. And so Well, I don't really have a question about this. I just, again, want to hear your thoughts on, this is another source that I would think of where central banks, especially in the US and Europe, need to gain increased legitimacy because of the impact, not just on their own societies, but across the world, and who they're accountable to, and what exactly legitimacy seeking could mean for their international and their domestic operations. I'm going to stop there, but again, thanks for a great talk and for the chance to discuss your work. I always enjoy reading this, and I'm looking forward to seeing where these projects go.
Thank you, Aditi. Well, next up is Trevor Jackson, our own IIEP and GW Trevor Jackson. Are you there, Trevor?
Yes, I am, James. And hopefully audible to everybody. Well, first of all, thank you, Ben, for that excellent presentation. I was greatly looking forward to this, and I must say that you did not disappoint. And Aditi, you are a difficult act to follow. A lot of what I'm going to say will be similar, but maybe predictably, I'm going to frame my questions and comments a bit more into sort of change over time framing, the way that we historians are trained to do. Most of my questions and comments are just asking for more elaboration and an excuse to hear you talk more about this. So you started with Paul Volcker, as we all do, and one of the striking things about starting with Volcker is that it raises a set of questions about central banks as singular actors. It raises a question about who is the constituency of central banks, which you touched on. And it sort of raises a question about periodization, right? And so, one of the big or striking puzzles about the Volcker recession is that it immediately follows the passage of the Humphrey-Hawkins Act that gave the Fed its dual mandate of providing full employment, which, of course, Paul Volcker then does not do. Right? And so this seems like one of the classic cases where the central bank is acting autonomously from its its ostensible political control. So my first set of questions is whether you think there was a discrete era, whether we call it the Volcker era or not, of say 1979 to 2008, 2016, 2020. Like, where do you see that? Do you see this as a discrete era in the history of central banking that has come to an end or is coming to an end? I'm thinking there of the piece by Adam Tooze about the way that this era of central banking had died, but like the cartoon that runs off the cliff and doesn't realize it, it's only the crisis of 2020 that has revealed the ways that this old paradigm of central banking has stopped working. From that, right, as I think about your evidence from the speeches, which I also found striking, some of the things that I notice are, first of all, that is a lot of speeches. Right? I did the division from the paper, and it works out to a central bank speech every 3 days for something like 20 years. Do you have the sense that over that period of time, as Didi suggested, that the central banks are talking to different people, or that there is a sort of accumulation of extra people that they're talking to? Are they making a bigger effort to communicate to the general public? At a central bank speech every 3 days, even for somebody like me who studies central banks, I don't consume them that much. Who do they think the audience is? And to what extent are they sort of discussing everything that could possibly be within their remit? Which then brings up the question of whether this silence is strategic, as opposed to some other possible explanation for the silence that you observe. The possibility of finding a way of proving a strategic silence is a very tantalizing one to the historian, because we are constantly bedeviled by the problem of the archival gap, right? That somebody who breaks a law leaves a record and gets caught, right? Leaves a record in an archive in a way that somebody who breaks the law and gets away with it doesn't, or somebody who follows a law doesn't. And so we can kind of only observe a subset of the total behaviors. And so I'm just hoping you can elaborate a bit more on how you came up with this intuition of the strategic silence, how sure you are that the silence is strategic, as opposed to representing some internal shift in the power dynamics or the factions within central banks, how much there are other silences on other issues that aren't as strategic, or are but aren't as germane to the topic. How should we think about this, and how sure are you that what you're seeing is what you're seeing? And that possibility of different factions rising and falling, in turn kind of speaks to the possibility that central banks themselves are not as unified political actors as we like to think of them. Right? One thing that I find very productive about your work is the intuition that we should think about central banks as actors rather than agents, right? And we should move beyond thinking about the turf war between them and their political leaders and focusing on, are they interdependent, are they independent, how should we think of this? Well, okay, if they're actors, right, is it possible that there are different factions within them pulling in different directions? Right? And when you, as you often do in your work, speak about paradigm maintenance, right, is paradigm maintenance something where the paradigm shifts because of some internal struggle over the interpretation of external anomalies? Or is it something that is kind of coming from the constituency without, right? That there's some change in the financial markets in the constituency that central bankers are speaking to that means that they need to change their language in order to maintain their legitimacy, right? Sort of in which direction does this change happen, right? And there again, Volcker seems like a pretty striking case. Where often the kind of conventional narrative is that he comes in with a new set of ideas, implements them very dramatically, and that changes everything. And then from then, the Fed, the IMF, BIS spread that logic around the world, right? And so I'm thinking of Julia Johnson's book, Grease of Prosperity, right, about all of the training programs. Is this paradigm that you were discussing kind of the professional logic of central bankers? Such that as long as they are doing central banking as an intelligible activity as we understand it, there isn't much change, right? Because it isn't like an ideological view of the world, or what you're describing is this just the propagation of what sometimes is a dirty word, but I'll use it anyway, of neoliberalism, right? And that an external political defeat of neoliberalism would be the thing that would change this paradigm, rather than any kind of, as you put it in one of the papers, changes to the territory that demands a change to the map, right? If 2008 didn't change the paradigm, if 2020 doesn't change it, right, how much can it really change? And then just as a final question that I kind of want to sharpen, for many people, including many people on this webinar, the key challenge to inequality is about poverty, fundamentally. It's about bottom-end deprivation. And the historian Sam Moyn, a year or two ago, wrote a book about inequality and what he thought changed in the 1970s. And his thought was that people who cared about inequality shifted from caring about what he called substantive equality, which is to say, right, both top down and bottom up, and shifted instead to caring about absolute deprivation. And so I just sort of want to explicitly ask, is the answer to the so what question from your work that poverty alone won't solve inequality, but in fact that through all the channels that you've described, inequality and central banking together be in a kind of top up, right, direction of inequality will continue to produce more types of inequality, more instability, et cetera. So I think I will leave it at that and turn back to you, and then I think we'll take questions from the audience.
Absolutely. Thank you, Trevor. That was great. Now, I think it would be a good idea to let Ben have a chance to respond to you and Aditi. Go ahead, Ben.
Okay, thank you so much, both of you, for these extremely, incisive comments, and for even reading the two papers that I sent you. I really appreciate it. I won't be able to respond to all of these comments because I understand that we don't have that much time, but I will be in touch with you both after via email. And so let me just say very briefly, first on this last point, Trevor, that you raised, inequality being about poverty first and foremost, and substantive deprivation. I think what is interesting and important here is that central banks and these three distribution channels of monetary policy make this quite clear. Central banks act on inequality both from the top via policies that affect the value of financial assets. And financial assets is the main component of the portfolios of the very rich. Certainly in the US, more so in the US than anywhere else, but also in Europe. And of course, privately held businesses and so on. All of these assets, their value fluctuates a lot with monetary policy and the prospect for inflation and so on. So a lot of the fluctuations in the at the very top of the wealth distribution have to do with monetary policy, but at the same time, you know, the outcome that is most important to the economic status of, like, let's say, the bottom 50% is the labor market, or probably the bottom 90%. It's just that the further down you go in the income distribution, the more precarious, as a matter of fact, employment becomes. And so when a Paul Volcker creates a recession, you know, people further down the income ladder tend to lose their jobs first, as an empirical matter, I think. And so central banks act very directly at, you know, on both ends of the income and wealth distribution, and this really shows how powerful they are in that regard. And the campaign for the Fed to let the labor market run hotter than it would have maybe expected a few years ago, I think was quite successful in raising this issue of how costly it is in terms of reducing inequality to, you know, step on the brakes, as also the European Central Bank has done several times since its inception. So raising awareness around this issue is as important, I think, as around the issue of underwriting the value of financial assets. Both are important. Let me see one other point, at least, that I could respond to. Why do central bankers communicate? Okay, so Aditi, you asked the point, from whom are central bankers seeking legitimacy, and that relates to Trevor's question about has there been change in who these central bankers are talking to? Just very briefly on this point, yes, there has been an attempt, especially in recent years, of many central banks to reach a broad audience, and the Bank of England has been particularly vocal in this regard, but also the Fed and the ECB, the ones that I've looked the most at. And then there are actually many central banks, also in much smaller countries, that have pursued this agenda. And I think this is a good thing for the central bank to try to speak not only to bankers, basically. Historically, central bankers only spoke to bankers. This has dramatically changed, I would say. However, I am very skeptical as to the potential for central bank communication to open up a new accountability channel for central banks. That said, I do believe that central banks act according to their public, in response to the public's perception of the legitimacy of their actions. It's just a question what public we're talking about there. Ultimately, it's much more important for the Fed what's in the Wall Street Journal, and for the Bank of England what's in the Financial Times and so on, than what ordinary people feel or think about the central bank. This does not really translate, I would say, except, and this is a significant development, and there I'm speaking from Germany, our right-wing party, new right-wing, far-right party, started, the Alternative for Germany started as an anti-Euro party, and then swerved far to the right very quickly. But there is this new component of many right-wing platforms, actually, which is they have an anti-central bank component, which is noteworthy, I would say, in that regard. And so now there are papers by people such as Charles Good about central banking and populism. This is certainly something to watch. Thank you again, both of you. I'll stop there and follow up.
Well, great. Well, we have some questions, so I'll just give you three ones really quickly. Hold on. First off, Asif Dalla is asking, QE lowered the house prices. So why would central banks not talk about it? Second, Brandon Hiller asked, thanks, Benjamin. I'd love to hear more about your findings regarding the Bank of Japan. And Japan, which has led the way on many unorthodox policy measures, represents any interesting initial findings. Thanks. And then finally, Ann Vroom has said, in his publicly broadcast online interview at the Peterson Institute on May 13, 2020 in Washington, D.C., Chairman Powell repeatedly used the phrase, quote, we, the Fed, can lend but not spend, end quote. Any thoughts about this? Thanks.
All right, these are great questions. Thank you very much. I will go through them as quickly as possible. The first question about house prices. So house prices fell dramatically in many countries after or as a result of the 2008 financial crisis. And then in many countries have risen again steeply or rose again steeply since then until very recently. And this has been attributed, among other factors, to quantitative easing by central banks, by these 5 central banks. Of course, there are spillovers then to other countries. So house prices in non-QE countries go up as a result of QE by the Fed and the ECB, because the financial system is a global financial system. But the point is, rising house prices are good for those who own houses and are bad for those that don't. So there is a distributive dimension first, and then the net effect on inequality is a different question. The main point is that, and in a home ownership society, this is less of a problem, obviously, than in a society, say, like Germany, where the home ownership rate is relatively low. So the hostility towards the European Central Bank in Germany is partly a function of that, I would say. But so it's a good thing for some and a bad thing for others. And then these relative shares are different in different countries. And so, and depending on how loud each side can be in the public discourse, this, would push central bank legitimacy one way or another. I think so. It's an empirical question depending on each country. Japan, I don't have to say very much, except maybe that the Bank of Japan is, beside the European Central Bank, the one that has talked in its public speeches the most about labor market issues, from what I've seen, just looking through our data. We have not looked into this in more detail, but that's something we want to do next, which intuitively would make sense, but I'm not yet sure what's behind that. And then Jeff Powell, we can lend but not spend. Yes, this is true, I think, broadly speaking, and points to the problem with central banking and also to the answer of my question, well, what should be done about this? And I think the most important answer to this is that fiscal policy does not suffer from a lot of the problems that monetary policy suffers when it comes to the distributional consequences. Of course, fiscal policy can be deployed in all kinds of ways. You can choose the distributive consequences that you want to have from your fiscal policy, but it is much easier for fiscal policy to be deployed in an inequality reducing way than monetary policy. Because monetary policy, the short answer is, works through the financial system and through asset prices first and foremost, and wealth effects. And that really limits, the progressive distributional outcomes that you can achieve with monetary policy. You can keep people in jobs, yes, and that's important. But then the rest of it, fiscal policy, is better from a distributional perspective, or can be better.
So all told, Benjamin, question. What do you think is going to happen after this COVID situation subsides, let's say in another year and a half, 2 years? What will we be left with? Compare and contrast to 2008, which was financial, of course. This is health, economic, and perhaps financial. We're not there yet. Give us your viewpoint, your overview, what you think. And what others are saying as well would be good enough as well. Thanks.
Thank you, James. That's a big one. Of course, I do think it is unlikely the easy thing is to say that I think it's unlikely that we will see a return to the pre-2008 normal in central banking. So the age of small central banking, in the sense that we all more or less buy into the fiction that monetary policy is, a matter of just manipulating the short-term interest rate with price stability in mind. That era is over, and that, I think, to come back to Trevor's question, what the Volcker era, that was the key narrative of the Volcker era, which was also, of course, the Greenspan era. Tinkering with the short-term rate in order to fine-tune the economy. That is clearly over. The footprint of central banks has just gotten a lot larger again in the economy and in the financial system. And so with that fiction dead, I think it is simply impossible to return to central bank independence as we know it. And the way in which I see this unfold is more scrutiny of central banks within existing accountability mechanisms, which is hearings, congressional hearings for the Fed, which includes hearings for the ECB in the European Parliament, but has recently been enriched with, Mario Draghi showing up in the Dutch or the German Parliament, completely unheard of occurrences until then. So this, I think, will continue. Civil society will continue to play a more and more important role in, I think, holding central banks to account. And appointments are becoming more and more politicized. And of course, the US is the most spectacular example of this. But, I mean, I would say this is not necessarily a bad thing, even though, of course, I'm not talking about the current appointment process. But in principle, I don't, appointments to the European Central Bank were always politicized, but in a behind the scenes kind of way. When you look at them, the people who got appointed, there is always national proportionality considerations and so on and so forth that play an extremely important role. And if that were to become a explicitly politicized process, I personally would not have a problem with that. So I think, yes, politicization will continue in various ways. The question is how this will then be institutionalized in the form of legislation. And there, what is noteworthy is that institutionalization is extremely difficult in the euro area because of the treaty character of the mandate, the statute of the European Central Bank, whereas in other countries, Parliament can just change the law, and then you have a completely different regime.
Great. Well, I have another question that I'll. Good afternoon from the Central Bank of Malta. Assuming that central banks generally act in good faith, do you think that central bankers are attuned to the infrastructural power of financial markets and consider it benign or a lesser evil? Or do you think that they do not possess a full awareness of this? Okay.
All right. Well, thank you to this
The
question
next
from
one
the.
from Luke, by the way. Yes.
Okay, from Luke, Central Bank of Malta. I hope that central banks are attuned to the infrastructural power of financial market and market actors. So the power that financial market actors enjoy because monetary policy operates through financial markets, especially through the interbank market, of course, but also through capital markets. Personally, I don't think they are attuned to this particular problem, but they are aware that, I'm sure they are aware that they talk a lot more to financial market participants than they talk to any other participants in the economy. And that, again, is inevitable given how monetary policy works, and this cannot be changed by central banks. So I would think that individual central bankers are attuned to the power of finance generally. I just think they really can't do very much except be aware. I would say it's a minority of central bankers. I haven't even talked about the revolving door in this talk. There's a book about this too by Adolf, Central Bankers as Bureaucrats, or some such title that is very good on this. And I think it's an important factor if you look at where central bankers, including from the Fed, go after their active careers. The pattern is quite clear.
So we have one final question. The question is about India and China. Central bank policy in India and China. We've seen a lot of a decrease in poverty in those two countries, but yet a continued, in fact, increase in inequalities within the two. How do you see the outlook there and the transmission mechanism between central bank policy that they have and their inequality?
China, right? This question was about China?
China and India.
And India. Okay, this is certainly beyond my immediate area of expertise, so I'm not sure I'm qualified, except to say that central bank policies need to be seen in the context of the broader growth model of a country. And just in the way in which the exchange rate component of QE is an important part of QE for the Bank of Japan and the European Central Bank. The exchange rate component is very important for China, and more generally, let's say financial repression has been an important way of over the last 20 years, maybe less and less so, of maintaining an investment-led growth model there, and the accumulation of foreign exchange reserves, dollar reserves, by the central bank in China. Yes, certainly creates path dependencies for the global monetary system and other central banks too. So that's another interesting aspect of this, but I'll leave it there.
Well, then we'll all leave it there. Thank you so much to Benjamin Braun, who has joined us today talking about central banking in a time of inequality. Aditi, thank you. Adita, thank you so much, Adita. And Trevor, I think you're over there, right? Hello, Trevor. Thank you, Trevor. And now to the entire IAP crew, Kyle and Katya and the rest, thank you for helping put this together so nicely. To our participants, thanks for the questions, and we'll see you next time on Facing Inequality.